German top firms launch €100 billion investment to boost economy by 2028. In a bold move to rejuvenate the economy, over 60 of Germany's foremost corporations have announced a substantial investment initiative totaling at least €100 billion, approximately $116 billion. This ambitious plan aims to pull Europe's largest economy out of its current stagnation. This initiative is spearheaded by prominent leaders from major companies, including the heads of Deutsche Bank AG and Siemens AG, and is being coordinated with the government of Chancellor Friedrich Merz. According to a statement released via email on Monday, these corporate leaders have pledged a staggering three-digit billion amount in new investments within Germany by the year 2028. But here's where it gets controversial. Will this investment truly be enough to spark the economic revival that many are hoping for? As we delve deeper into the implications of this initiative, it raises important questions about the effectiveness of such large-scale investments in a time of economic uncertainty. Are these companies genuinely committed to long-term growth, or is this merely a strategic move to bolster their public image? We invite you to share your thoughts in the comments below. Do you believe this investment will lead to a significant turnaround for Germany's economy, or do you think it will fall short of expectations? Let's discuss. Germany's €631 billion investment plan, reviving the economy. In a bold move to rejuvenate its economy, Germany's Chancellor Friedrich Merz is set to engage with leaders from 61 prominent companies on Monday. These firms have collectively committed a staggering €631 billion in investments by the year 2028, aiming to restore faith in the nation's economic stability. This initiative includes major players like Deutsche Bank and Siemens, who will showcase their Made in Germany projects to Merz and Finance Minister Lars Klingbeil. The pledged €631 billion encompasses a variety of financial commitments, including capital investments, research and development expenditures, and international investment pledges. This is particularly significant as Germany's economy, once a dominant force in Europe, has faced 2 consecutive years of recession. Experts predict that 2025 will be particularly challenging, with growth forecasts ranking among the lowest in the developed world. Siemens CEO Roland Busch emphasized in an interview with Handelsblatt that the funds being discussed represent both new capital and previously committed resources. He stressed the necessity for bold political reforms, stating, "We need the courage for structural changes in politics, and it is imperative that big steps follow." During the meeting, company representatives are expected to advocate for expedited approvals for infrastructure projects and strategies to address the ongoing labor market shortages in Germany. The government has indicated that the focus will be on enhancing the investment climate and making Germany a more attractive destination for business. Since taking office, Merz has prioritized the revitalization of Germany's economy, highlighting in a recent summer press conference that his coalition is taking the issue of cutting red tape really seriously. This meeting comes at a pivotal time, as the German government is anticipated to increase spending, facilitated by recent reforms that relax debt brake regulations and establish a dedicated fund for infrastructure investments. Clemens Fuest, president of the IFO Institute for Economic Research, noted that the push for innovation and support for new businesses is a positive development, as is the establishment of the infrastructure fund. However, he also pointed out that the government has implemented several measures that do not effectively limit spending or enhance growth potential. These include a bureaucratically heavy early start pension plan and a permanent reduction in value-added tax for the hospitality sector. Fuest concluded, overall, the review of the German government's economic policy reveals pros and cons. This raises an important question: are the current measures sufficient to truly stimulate growth, or do they merely scratch the surface of deeper economic issues? What do you think? Share your thoughts in the comments.